Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Daybreak Weekend, our global look at the top stories in the coming week from our Daybreak anchors all around the world. And straight ahead on the program, a look ahead to tech earnings from some of the Magnificent Seven. Also, a monetary policy decision from the Fed. I'm Tom Busby in New York.
I'm Caroline Hetke here in London, where we're assessing what is at stake at the next Bank of England policy meeting.
I'm Doug Krisner, looking ahead to earnings from Apple and Samsung and what these companies will say about artificial intelligence.
That's all straight ahead on Bloomberg Daybreak Weekend on Bloomberg 1130 New York, Bloomberg 99.1 Washington, D.C., Bloomberg 106.1 Boston, Bloomberg 960 San Francisco, DAB Digital Radio London, Sirius XM 119, and around the world on BloombergRadio.com and via the Bloomberg Business app.
Good day to you. I'm Tom Busby, and we begin today's program with the Federal Reserve. Fed officials holding a two-day policy meeting this week, issuing a monetary decision on Wednesday. Now, this coming Friday, we also get the jobs data in the U.S. for the month of July, something that could impact Fed policy moving forward. For more on what to expect, we're joined by Michael McKee, Bloomberg International Economics and Policy Correspondent. Michael, 7 meetings in a row, the Federal Open Markets Committee leaving rates unchanged. What do you expect to see on Wednesday?
Well, happy anniversary, by the way. It was July of 2023 when the Fed finally stopped raising interest rates. So we've been higher for longer. Is it for long enough? Probably not this week. The Fed has not given us an indication that they're going to cut rates this week, so there is no reason to think that they will, because they don't like to surprise the markets. However, the big expectation is for them to signal a September rate cut in the statement, and then Jay Powell to follow it up in his news conference. And that would probably produce much the same as a rate cut, in the sense that the markets will then start discounting a rate cut. Yields will go down, and it's sort of the same effect, even if they don't cut rates this time.
It's like a deke in hockey. Now, the hopes, the bets for a September rate cut, obviously being bolstered by some pretty encouraging data. Let's talk about that. On Friday, the PCE.
Yeah, Friday we got the PCE inflation numbers, which showed a sort of ongoing decline. The core rate didn't change on a year-over-year basis, 2.6%, but we did see the headline number go down to 2.5%, and that puts you in the within range of the 2% target.
In the ballpark.
And remember that Jay Powell and others on the Fed have said they don't want to wait to start cutting rates until they get to 2%. And he had sort of suggested at his last press conference that it was a range of 2 to 2.5. So
we're in that range.
We're sort of in that range right now.
Well, that's good. And earlier this past week, second quarter GDP grew by much larger than expected.
There were a number of people going into the week and during the week who were suggesting maybe the Fed needed to cut rates in July because otherwise they'd be behind the curve. But the stronger than expected GDP numbers, 2.8%, a big increase from the first quarter, sort of reassure them that they don't have to rush, that the economy is not on the brink or the precipice of recession. Now, that's not to say things can't get worse. This coming Friday, after the Fed meeting, we get the jobs report, which is too bad for the Fed. I'm sure they'd like it beforehand. But the unemployment rate there is, if it's 4.1% now. If it goes up to 4.2%, then that triggers the famous Somme rule that suggests that we're getting close to a recession, and that will scare the markets, that will scare the horses, and we may get a reaction in the markets.
That's the barometer, 4.2%?
Well, it's not 4.2%. It's a bit complicated, but basically the 3-month moving average, subtract from that the lowest 3-month moving average of the past 12 months, and you get a number. And then if it's greater than 0.5%, then it has always forecast recession in the past.
Wow.
And it would only take going to 4.2% to get that rate.
Well, let's stay on it on the jobs report this Friday. So now in June, a little softer, but still pretty solid, 206,000 jobs. What do you expect to see then in July?
Well, the forecast is for 175,000, but the last 3-4 months we have had forecasts in that range, and they've come in stronger than that. So I don't know if you're a trend better or not, but you might you might think that it's going to. At some point, it has to start slowing down, but it hasn't yet. The big number, though, as I say, is going to be unemployment. It's forecast to remain unchanged at 4.1%. But, of course, a lot of this, you get into the 3 digits, and you can get rounding, and it could go up to 4.2%. So there'll be a lot of focus on that because of this SOM rule thing. But it does look like, at this point, that wages are slowing down. They slowed down in the PCE numbers, and they've been slowing on a month-over-month basis in the employment numbers. Now, we get on Wednesday, ahead of the Fed, we get the employment cost index. That's something they'll be looking at to see what wages are doing. But if wages are well-behaved and we don't get a collapse in jobs or a big rise in unemployment, then the Fed is going to be satisfied with waiting until September.
And all that, the wages moderating, inflation, it appears to show that the Fed's higher for longer campaign is working. No disastrous impact on the economy.
No disastrous impact. I hate to use the soft landing analogy. It's almost become a cliche by now, but it looks like we're kind of there. Now, they don't want to say that because in the minute they do, it's like jinxing themselves and something will go wrong. But at some point, you got to, as the famous senator said about the Vietnam War, you got to declare victory and go home. Well, so maybe they'll do that this week.
Maybe that's coming. Well, the Fed wraps up its latest 2-day policy meeting this Wednesday. A decision expected around 2 p.m. Wall Street time. And our thanks to Michael McKee, Bloomberg International Economics and Policy Correspondent. We move now to earnings from some of the nation's biggest tech companies on the heels of kind of disappointing reports from Tesla and Alphabet last week. Now, in the days ahead, we're going to hear from more of the so-called Magnificent Seven, like Microsoft, Meta Platforms, Apple, and Amazon. And for more on what to expect, we're joined by Mandeep Singh, Bloomberg Intelligence Senior Tech Industry Analyst. Now, Mandeep, let's start with what we saw last week, Alphabet and Tesla. What was it that rattled the markets and investors?
Sure, Tom. So, look, when it comes to Alphabet, it was pretty obvious that the market is focused on what they're going to spend on CapEx this year. And the fact that, they spent $1 billion above consensus expectations for this quarter and said it's going to be higher than their 2Q numbers for the next 2 quarters. Clearly, it suggests that they will keep spending. And the CEO mentioned that in his remarks that they would rather overspend right now on AI as opposed to underspend. And look, I think what they are suggesting is they want to build more capacity because they're seeing that reflected in the cloud numbers. So in the case of Alphabet, Google Cloud segment actually had a sequential acceleration. It grew 29%. And what it tells me about Microsoft is, look, they will be reporting next week. And last quarter, Azure, which is the equivalent of Google Cloud, grew 31%. At a much higher base, Microsoft Cloud is a $76 billion run rate business. Google Cloud is about $40 billion. And so if they're able to show AI contributing to the growth in Azure segment, then clearly, it's paying off for these hyperscalers. And in the case of Microsoft, they're also monetizing it with their Office Copilot. So you want to see an acceleration in both those segments, Office Copilot as well as Microsoft Azure, the infrastructure side. And look, with Tesla, I think it was more idiosyncratic because they set expectations for a robo-taxi launch on August 8th. Then they said they'll move it to October 10th now.
And it's only a prototype, not even a real vehicle yet.
Yeah,
right?
But I will give them credit to the extent that, they're still the furthest along when it comes to doing something like this. So think about all the other car makers. They're not even in this game.
Not close.
So the fact that they are spending those R&D dollars on something that could be a big market down the line, whether it becomes feasible this year, next year, clearly, I think they still have a lead. And obviously, they're not managing expectations very well, which is why you see that sort of stock reaction. But I feel with Tesla, it's going to be volatile just because, it will all depend on how quickly they time this to market.
Yeah, when they deliver. Now, that was then. Now, this week, looking ahead, we're going to hear from, you already brought up Microsoft, Azure, its relationship with OpenAI, and it's, they're way ahead of the pack on AI, aren't they?
Well, I think what you're finding is other competitors are catching up when it comes to the large language models. So this week, Meta actually released their latest large language model, the 3.1 version, and they have closed the performance gap. I mean, look, for consumers like us, we read, about these models and the fact that they can reason, they can generate images, they can generate text, do summaries. But it's very hard for us to see real-time use cases because it's still, in the development. These companies are in the process of deploying it. And to me, the fact that they are kind of comparing themselves on benchmarks and saying the performance is almost equal doesn't bode very well for OpenAI because Anthropic, Meta Llama, they're all catching up. At the same time, with that being said, Microsoft still is showing it in the numbers. That's why that growth rate of Azure and the Copilot contribution is very important. If you start to see that moderating, then clearly, the lead is narrowing and that will have an impact. Instead of Microsoft being the clear winner, you will have others kind of catching up
fast.
Yeah.
Well, now that leads me to a point. Meta platforms, it's always been about user numbers for Facebook, WhatsApp, Instagram. Advertising revenue is Wall Street. Now, putting that behind them and just focusing on AI and what have you done for me lately? How have you monetized AI? Or is that still going to be a big focus? How many average daily and monthly users?
It will absolutely be a focus because guess what? Meta will also raise their CapEx. And we know the CapEx increases right now are not helping these companies when it comes to the stock performances. We saw a negative reaction with Alphabet. I expect something similar with Meta, given the valuations these companies are trading at. Remember, Mag 7 stocks have done phenomenally well. So the valuations are rich.
Yeah.
And so any increase in CapEx is not good for the stocks. And so clearly, Street cares about monetization. And if Meta is saying we are open sourcing our large language model and we have no kind of roadmap to monetizing it, that's not good news.
No.
And so they are the only ones right now who are open sourcing everything on the generative AI side with no plans to monetize. Remember, Google and Microsoft are monetizing through their cloud, through their copilots. They're not open sourcing it. Meta is the one that's saying, we are giving it away for free.
Well, a full slate of tech earnings in the coming week. A lot to look forward to. Our thanks to Mandeep Singh, Bloomberg Intelligence Senior Tech Industry Analyst. And coming up on Bloomberg Daybreak Weekend, a look at what's at stake at the Bank of England's next policy meeting. I'm Tom Busby, and this is Bloomberg. This is Bloomberg Daybreak Weekend, our global look ahead at the top stories for investors in the coming week. I'm Tom Busby in New York. Up later in our program, a look at more tech earnings, including from Samsung. But first, it's approaching 10 weeks since we last heard from Bank of England Governor Andrew Bailey and his fellow policymakers. Now, with the Bank of England rate decision due in the coming weeks, Bloomberg Daybreak Europe anchor Caroline Hepker has been gauging the anticipation in London.
Tom, after the UK has seen some volatile economic data in recent weeks, including faster than anticipated inflation numbers, so the sense of radio silence is all the more consequential before a decision on whether to cut UK interest rates that investors are judging to be on a knife edge. Unlike peers in the US and the Eurozone, Andrew Bailey has played down the importance of spoon-feeding signals to the markets. But the Bank of England's approach to messaging has been criticised by the former US Federal Reserve Chair Ben Bernanke. And a false start to rate hikes back in 2021 has also bred a persistent level of scrutiny of the governor's tactics. While 4 members of the 9-person Monetary Policy Committee have communicated following the 4th of July election, most were already seen as being in either the hawkish or the dovish camps, revealing little of what investors did not already know. The upcoming decision then could be a pivotal turning point. Andrew Bailey must decide whether to support two rate setters already pushing for cuts or continue to side with the hawks, warning that underlying price pressures still pose a danger. It's something that Bloomberg Television has been discussing with Janet Henry, who is Global Chief Economist at HSBC. She says that Bailey's choice will have a big impact on her strategy.
We are looking for some modest rate cuts over the course of the next year. We do have a gradual improvement, but it's by no means a V-shaped recovery, and it's certainly still not a recession. As you know, we've never been in that camp. But obviously, we have got this enormous uncertainty regarding the fiscal backdrop through 2025. You know, even last year, the fiscal deficit widening added to inflation, added to GDP growth, and should we find ourselves in a similar situation in 2025, then that would probably mean a lot less in the way of rate cuts.
How much visibility do we really have on 2025?
Well, we don't have a lot of visibility on 2025. And, of course, it's not just the domestic politics and the domestic fiscal. There is this geopolitical overlay. In fact, you know, one of the remarkable things you might say through the first half of 2024 is that despite all of this uncertainty in terms of conflict underway in the world, tariffs that are still coming through, not just from the US, but some from Europe and even parts of Latin America. Despite all of this uncertainty, the global economy generally has muddled through. It's just that it's still really the US and, for an emerging market perspective, India that have been the stellar performers. But you're right, 2025 is the key area of uncertainty, and central banks, you know, the age of medium-term forward guidance is way behind us now.
That was Janet Henry, Global Chief Economist at HSBC. Well, I've also been discussing the stakes of Andrew Bailey's big decision with Bloomberg's Chief Economist, Dan Hansen. He says the choice will have far-reaching consequences.
Well, I wish I could say this with a lot of confidence, but I'm not sure you can. I think we're on the side of the case for cutting. That's our view. But it's really easy to make the case for a hold as well. It's not a clear-cut decision. Markets are at about 45% chance of a cut, so slightly less than a coin toss. They're not convinced. You know, I think on balance, if you look back to at least the June meeting, it felt like the bank was quite keen to cut. If you read the minutes, you know, you could potentially read between the lines and try and make an argument that the elections they just didn't want to get involved during the election campaign. Since then, the data's been a bit choppy, but I think, you know, for us, the case is still there. But as I said at the start, there's a lot of uncertainty. We've also got quite a few changes of personnel, or at least one change, I should say, of personnel on the MPC that makes it just adds that element of uncertainty in the vote split that will come out.
Yeah, I mean, you talked about the election. Of course, that meant that there was a blackout period. Actually, it's been a really long time since we've heard from Andrew Bailey, maybe his longest period without communicating as Bank of England governor in the kind of 4 years that he's been there. And since then, fellow MPC members have also been quite quiet. I mean, how significant is that to have so little guidance from policymakers? Yeah,
I mean, it's an interesting one. I've been quite surprised, if I'm honest. I thought coming out of the election blackout period, you know, as I say, we had the June meeting, we had the minutes from that, but I thought Bailey and others would come out and I don't say set the record straight. That's not quite right, but just give an update on where they think things are. You know, we'd had a lot of data, and we know at the June meeting, we don't know who they were, but for some members of the MPC, the decision was finely balanced. And I think it would have been, I think there's a belief amongst economists and in the market that, you know, Bailey was amongst that group. It would have been interesting, I think, to hear from him and where things are. I don't necessarily think he would have made it 100% clear about what they were going to do at this meeting, but I think something around the data and, you know, the weight they were placing on upside surprises and how worried they were about that, I think would have been a useful guide, because there's been a lot of volatility, as I say, in the data, and that's injected volatility into market pricing as well, which I don't think is particularly helpful.
Okay. There does seem to be, though, after the election and the turbulence that we've seen in politics, perhaps a window where maybe UK politics is calming down, and there's been a lot of announcements from this new government about the things that they're going to do. Obviously, it's all untested yet, but certainly a feeling that there's maybe an opportunity for more calm now in the UK. How useful would a rate cut be to the new Chancellor, Rachel Reeves? There does seem to be more optimism, and you've written about it, about economic growth maybe being a bit better in the UK now. Yeah,
so I think on the rate cut point, obviously I think there's a really positive narrative around that the government can spin. Does if it's a 25 basis point rate cut, does that change the economic outlook? No, but if it's a series of rate cuts, it does begin to sort of feed into economic activity. But remember, the sort of mortgages and the like are already being priced off the expectations that rates will be cut. So the bigger risk is they don't get cut, and then we sort of have this sort of knee-jerk in the other direction. I mean, thinking fiscally, if you go back to the OBR's forecast in March, there was actually a lot more easing priced into the curve at that point. So there was sort of this exuberance around the number of rate cuts that come this year. So actually, in terms of fiscal, the sort of debt interest spending and the like is probably going to be a little bit higher in the OBR's forecast, because we've got higher gilt yields and also higher expectations for bank rate relative to March. But, Reeves will want to see rates start to come down. That sort of narrative, I think, is one much more probably political than it is economic. As I say, on the economic side, a lot of this is already baked in. The idea of 2 rate cuts this year has been the sort of consensus for quite a while now. And it's just a case of, from her perspective, hoping that the bank ends up delivering that.
How much influence will the Fed have on the Bank of England now?
Yeah, that's a good question. I think, the argument, one of the arguments for waiting to September is it looks like the Fed's going to go in September now, though there are some voices saying that July is, we had Bill Dadd on the terminal in his opinion piece saying that July would be the right time for them to go. I think, one of the arguments is that the US is ahead of the UK and the rest of the world in its inflation process. If the Fed goes, it gives other central banks confidence. That said, the SNB, Bank of Canada, they're all going ahead and cutting rates. They're not waiting for the Fed. So I think the bank doesn't need the Fed to go. I just think, you'd look across the Atlantic, and it would just give you a little bit more confidence that you're sort of moving in the right direction. So it's something they keep an eye on, but I don't think it stops them from cutting in August.
Returning to the UK story then around mortgages, I mean, the Institute for Fiscal Studies, interestingly, in recent days has come out with this view that the interest rate increases from the Bank of England have pushed 320,000 more people into poverty. Which I think is quite interesting. I mean, the IFS always does hold the government of the day's, feet to the fire, or the Bank of England or whoever. That is their job. But I think that is quite interesting, isn't it, in terms of the pressure as we look at the more positive economic story versus the pressure that there is on UK consumers. Yeah,
definitely. I mean, at an aggregate level, we've spoken for a long time about the resilience of the UK economy. You've mentioned there the sort of pick-up in growth, but the distributional effect of all of these things is significant, and that's sort of what the IFS is citing there. The fundamental point is that interest rates are the Bank of England's main tool, but it's an extremely blunt tool, and it does have these negative effects. I mean, I think what's interesting is that those sort of numbers, and you've seen insolvencies, they've come back down, but insolvencies picked up as well on the back of rising interest rates. And actually, it's surprising, I think, against that backdrop, that the economy has, at an aggregate level, performed as it has. There is a lot of stress out there, and look, I think, as I say, interest rates are a very blunt tool, and I think, at least if you're thinking about the distributional impact of these things, it's really a fiscal policy question, and that's, I guess, is something that Rachel Reeves might end up thinking about.
Yeah, I mean, a last thought on Reeves, going out, making the pitch again and again in recent weeks, now that she and Keir Starmer are in power, that the UK is open for business, that's the mantra. She's really got to deliver, doesn't she, or more investment coming into the UK sort of longer term. That's the underlying pressure for Britain. Yeah,
I mean, they've really upped the ante, actually, on the narrative, and some of the goals that they've set are very challenging, I think. And, if you remember back to the previous government, Rishi Sunak had his 5 targets, and there was a lot of, holding him to account about, whether he was achieving these things on the economic front, but also obviously on NHS waiting lists, on the boats as well. So, if it doesn't all come to pass, they're gonna feel the heat again, I think. And as I say, they are extremely stretching targets that they've set, particularly on growth. And obviously, we all hope that it comes to pass. Everyone wants living standards to rise. That is sort of the best possible outcome. But as I say, that if you look at recent history, it would suggest that we're going to go through a quite significant step change in economic performance to deliver it. And you sort of, me being a skeptical economist, I'm a little bit skeptical about whether it will come to pass, but we'll see. We'll see how it goes. As you say, it's a lot of rhetoric, but they need to put the policies in place and see whether it delivers now.
That was Dan Hanson, Bloomberg's chief economist, on the Bank of England's rate decision, which we'll hear about, of course, on Thursday, the 1st of August. I'm Caroline Hepker here in London. You can catch us every weekday morning for Bloomberg Daybreak Europe, beginning at 6 a.m. in London. That's 1 a.m. on Wall Street. Tom.
Thanks, Caroline. And coming up on Bloomberg Daybreak Weekend, a look at earnings from both Apple and Samsung and what these companies will say about artificial intelligence. I'm Tom Busby, and this is Bloomberg. I'm Tom Busby in New York with your global look ahead at the top stories for investors in the coming week. A big week ahead for tech earnings with some of the biggest manufacturers in Asia, companies like Apple and Samsung reporting. For more, let's get to Bloomberg Daybreak Asia hosts Doug Krisner and Brian Curtis.
Tom, both Samsung and Apple are putting emphasis on AI features in their latest smartphones. The aim here, obviously, is to create a lot more buzz when it comes to AI technology where consumers are concerned.
Apple has been doing so after falling behind the likes of OpenAI and Alphabet's Google, but is playing catch-up now on the AI front with the introduction of Apple Intelligence. It also aims to ship 10% more new iPhones. Meantime, Samsung had earlier announced that it would hike prices on its latest models with the addition of AI features. It aims to reclaim its title as the world's leading maker of foldables.
Earlier, Brian and I spoke to Dan Ives. He is managing director and senior equity analyst at Wedbush Securities. He thinks Apple is the core player in AI.
Especially when you look at Apple Intelligence and what's happened with iPhone 16, we think that's how you get to a $4 trillion valuation in Apple with an unparalleled install base. The reality is that consumers, when they go through AI, they're going to go through the Cupertino and essentially an Apple device. That's how 25% of the world's going to access AI. You talk about other names that benefit here. I think there's names like an Oracle, ServiceNow. I look at names like Palantir. That's really a pure play name in terms of use cases. So there's a lot of, you talk about narrow. It is narrow now. But over the next 1-2 years, it's going to be a lot broader.
So it's 9 p.m. The party's going till 4 in the morning. Do we need to talk about regulatory risk? Is there at some point a move on the part of government officials to get involved in how artificial intelligence is regulated? Is that a concern that you have?
I mean, that's at 4:35 a.m. when you're at the diner after when you're at the diner after the party. So the point is, regulatory will be there, but for now it's not. I mean, it's self-regulation. You spend a lot of time in the Beltway. Regulatory is going 30 miles an hour in a minivan the right lane. The technology's in a Bugatti going 100 miles an hour in the left lane. So I don't think regulatory is going to be an issue. And I think regardless which presidential candidate wins, I also think we're going to see less regulatory, and which ultimately I think is bullish for big tech.
Well, let's get a broader question answered here from you, Dan. Do we need to worry about a slowdown in the economy as kind of spoiling the party, or no?
I mean, I think right now, unless you have a telescope or binocular, you don't see a recession, right? So I think we're in this Goldilocks soft landing. I'm not saying it's rose and champagne. There's clearly choppiness, but if you look at overall tech earnings, it's bullish. Look at overall bank, broader. 85% are hitting or being earnings. So I think that will be in the background, but it's not going to stop this AI freight train.
He is Dan Ives of Wedbush Securities. And joining us now from our studios in Hong Kong is Vlad Savov, Bloomberg tech editor. Vlad, thanks so much for being with us. In the last week, the equity market clearly was expressing concern over the issue of valuation when it comes to a number of these artificial intelligence names, particularly the chip makers. I don't sense that the thesis has really changed. Fundamentally, most people still agree on the transformative nature of AI. Yeah, there may be some debate over the use case when we point to what AI can ultimately provide currently. The issue also seems to be on the return of investment. I was reading a note from Barclays saying that analysts are expecting big tech companies to spend around $60 billion a year on developing AI models by 2026. Here's the thing. Those companies will only reap around $20 billion a year in revenue from AI. So it seems like the market is right at this moment in time to be a little concerned about how quickly we've arrived at this point. Is that fair?
Yes, I think naturally that is fair to say. It's also worth bearing in mind that when you say 60 billion for all of big tech spending on AI, I mean, a good chunk of that, 40 billion is going to be just Meta. They've already pledged to spend, like I say, double-digit billions of dollars just on AI, just on acquiring those hard-to-get NVIDIA chips. It's worth also thinking about the fact that this level of investment, which is going to come this year, next year, and the year after that, is probably not going to be sustained. And they're probably planning for that as well. You get those NVIDIA chips, you get that hardware infrastructure in place to train your AI models, and you do that, but then those models are trained, and then they start being deployed, and then people start figuring out how to use them. It's still very early days. We're still trying to find the actual application. We're trying to find the monetization methods, whether it's going to be through subscription services online, whether it's going to be additions to hardware. This is the big trend that we're seeing with device makers selling their devices as effectively AI vessels. It's buy a laptop. No, it's not the same old laptop. It's an AI laptop today. Same thing with smartphones.
We started off with Dan Ives asking him about a comment that we'd heard on Bloomberg, which was that Apple was the key. Apple was the company that has the smarts through the years to convert something into a friendly device for consumers. Do you agree with that? And to what extent is Samsung also in that category?
I agree, but only to an extent, because Apple's strength has always been to integrate hardware and software and a service that it can eventually charge for. We know that. We know that's been the case in the track record, but it's so much more wide open than it has been in the past. It really is such a wide open question for how you're going to take an AI service like an image generator or ChatGPT and its ability to translate and to generate text for you in all sorts of ways. How are you going to turn that into actual revenue at the end of the day? So absolutely, Apple has the pedigree for us to invest confidence in it. Whereas on the flip side, with Samsung, it actually doesn't. For all of its strengths and accomplishments, Samsung has never been great at software. It's never been great at coming up with the applications that run on top of its devices. It sells laptops, those run Windows. It sells smartphones, those run Google's Android. I
think it's fair to say that the weakness that we saw in AI-related stocks in the last week was touched off by the comments that we heard from Sundar Pichai, the CEO of Alphabet, who said, hey, it's going to take some time for AI products to mature and become more useful. But can we talk about how quickly things are evolving? The rate of change seems to be very clear. It's almost parabolic, right? And if that trend line continues, I don't think the market's going to have to wait too much longer. Am I right on that, or am I wrong?
I still think it's still going to take a good chunk of time. But to give an illustrative example for this, when you look at image generation, one of the earliest issues it had was with fingers. You would ask it to generate like a Renaissance painting for you, and you can always tell that it's AI generated because you could never get the right number or the right shape of fingers on people. It only took a few months, and those things are largely resolved now. It really is impressive, especially with image generation, because it becomes so obvious to see the rate of progress. So I fully agree with you that the progress is there. The question really is, and especially the trend this year, is with Microsoft and its Copilot PCs, Apple with Apple Intelligence, and Samsung making every Galaxy smartphone an AI phone, is they're trying to sell us, like I say, hardware as carriers of AI. So will that prove to be the successful tactic, or will it prove to be something along the lines of OpenAI selling you an all-in-one AI subscription?
I think the thinking on the device makers, particularly Apple, is that you need inference on this because of privacy. You need the intelligence, the AI, to be on that phone that's in your pocket. It's not drawing from the cloud because that's susceptible to interference and to security considerations. And that's why I think the comment goes to Apple knows how to miniaturize these things and get it into a very small phone.
That's right, Brian. And one of the things to bear in mind is that when Apple says, trust us, use only our proprietary software and proprietary hardware, you kind of can because, again, it has that pedigree. When Samsung says, trust us, only use Samsung software, it's a big question mark.
Vlad, I think we have to talk about China. It was interesting in the last week we heard from Texas Instruments, and the company made 2 points. One is that the market for the chips that TI is involved in terms of China, it's returned to growth. The second thing that I thought was very interesting was the company saying it's a mistake to assume that China is only doing simple semiconductor manufacturing. Do we have to talk about the degree to which China will try to play catch up in AI, or is the industry in China so far in the dust at this point, it's not likely that China will catch up anytime soon?
It might be possible to say yes to both of your questions because absolutely China is trying to catch up. There is no amount of giving up. Everyone sees AI as essential in the same way that they see technology and being connected and the internet as essential to building economic and industrial growth in the future. At the same time, there is this big gap. This is why we're seeing one of the examples that I like to recall is Nikon. We interviewed their president not too long ago, and they are renewing a machine whose design they haven't changed for over a decade. And that's because China is buying up so many of these mature chips, older technology chips. So as much as possible, China is trying to get the chips and the semiconductors and technology that it can, subject to the US sanctions, which means older technology, and then maybe with some amount of creativity and technical innovation and breakthrough to make its AI models lighter and easier to handle with older generation hardware, it can catch up. We should never be complacent about China's capabilities in this field.
In the broader picture, Vlad, it seems that now the market is giving 2 thumbs down to this rapid spending on AI features. And so I want to ask you a question that's kind of parallel to what Doug asked earlier about CapEx. For a while, companies were rewarded for their CapEx on AI. It showed massive commitment to what is a mega trend. Now it seems like they're being castigated. So the reason this is parallel is from the market point of view, okay, is this theme about not rewarding companies for investing in AI a passing notion, or is it something that will hold for a while?
It's a very interesting one, Brian, because Meta is kind of the perfect example for this. They really went wrong with technology. They went down this metaverse path, which is now all but forgotten within the company. They renamed the company. That's about the only leftover from we're going to build a metaverse for the entire world. And they invested super heavily into AI, and the market rewarded them. Nothing really changed. There wasn't anything special as far as Meta's prospects of making money at the end of all that investment. People just had faith and confidence in Meta pouring billions into the AI thing. Apple, likewise, it has really struggled with iPhone sales over the past year, especially in China, the world's biggest smartphone market. And then everybody heard about Apple Intelligence, and they said, okay, let's reward that. Now the trend is shifting in the opposite direction as everyone is sobering up about the length of time that all this investment is going to take to repay. And maybe things are just normalizing. I don't know that we're going to see the same levels of enthusiasm as we saw with Meta and Apple's examples, but I also don't know that anybody's going to be punished for investing in AI. We're not close to that.
Vlad, thank you so much for spending the time to talk about artificial intelligence with us as we look forward to the earnings in the coming week from both Apple and Samsung, and we'll have those reports broken down for you here on Daybreak Asia. Vlad Savov is a Bloomberg Tech editor. I'm Doug Krisner, and you can join Brian Curtis and myself weekdays here for Bloomberg Daybreak Asia beginning at 8 a.m. in Hong Kong, 8 p.m. on Wall Street. Tom?
Thank you, Doug, and thank you, Brian. And that does it for this edition of Bloomberg Daybreak Weekend. Join us again Monday morning at 5 a.m. Wall Street time for the latest on markets overseas and the news you need to start your day. I'm Tom Busby. Stay with us. Top stories and global business headlines are coming up right now.